Jonathan Camarda with a special edition video. Wasn't going to do one this week with my travels. However, given the circumstances, wanted to at least check in, kind of give you an overview of what we saw, some actions that we've taken. First of all, many of you heard that the SVIB Bank in Silicon Valley, 16th largest in the country, although it's a regional, service mostly venture capital, tech, healthcare, startups, I think private equity, and as such, pretty important source of financing for a lot of those companies and those startups. So what happened? Well, we're starting to feel the effects of the Fed, as they continue to look at 50 basis points, totally out of touch with what they're looking at with some of these inflated pseudo job numbers. And what's happened is a lot of the rate increases from last year, the patient is starting to feel that IV, right? They keep pumping it in. And what I mean by that is, well, again, when a bank takes in your capital, it doesn't keep it, when you bring the money in, it doesn't keep it there in the vault. Everyone grew up thinking that, and obviously many of you already know that, but just to, create a little bit simplistic, so just, humor me here. Lend the money out, and a lot of them invest in longer-term fixed income, right? So while the Fed was raising rates last year, right, rates are going up. What happens to bond prices, right? This is like fixed income 101. They go down. So when a large component of the bank's books are losing value because of rising rates, that obviously causes strain on the balance sheet. Now, you say, okay, that's great. That was all happening last year. Well, some of this takes time to work itself patient, right, through the system. Now, the confluence of that, it wasn't just that, but then we also had a need for money and capital from, they're looking at, I believe, technology and healthcare, mostly startups that needed a capital from the bank that they had given the bank because, again, lending out there is even tighter, so they had to go with some of their other capital they had invested. Take that in combination with the bank's balance sheet already shrinking, like somebody letting the water out of the pool, right before a hurricane, right? When you know that, folks, right? When you lower the levels for flooding. And that caused a situation where the bank was in emergency mode, and then they had to issue more debt and such. And once there's blood in the water, it doesn't take long for the dorsal fins. In other words, a bank run. And many of these companies, the FDIC protection, right, 250,000. Well, let's just say a lot of these companies, their heels were a lot bigger than that. In other words, they have a lot more invested than a 250. So what happens is everyone is going to want their money. 16th largest bank. So now there's talks of regional sank, regional banks and as such. The large banks, some sympathy dropping, but a lot of your large ones certainly not as much. And you'll hear the talking heads on TV say, wow, the large banks are fine. And, so this always happens. If you look at in 2008, when Bear Stearns fell apart, everyone's like, well, this is a one-off. Now, I'm not projecting that. However, you must proceed with caution. But you can't just, make rash decisions, which I'm going to get to portfolio strategy. So what happens is the California regulators shut everything down, and then Monday branches will be open, and then the FDIC deposits will be open for those to get the money out of what's in there. Okay, this is kind of a very simplistic nutshell. What does this mean to you? That's probably the biggest component, and the reason why I did this video, even though, like I said, I did not plan on doing one this week with travel. So what that means is, again, on Friday, of course, nobody saw, again, you don't see the fin until it raises above the water. I know a lot of folks think, well, wasn't this to be expected? Is it? Until it happens, no. And so it's how you react. What did I say on every video, right? We can't see the future, but how quick can you turn the wheel to miss the buck in the middle of the road? So then you'll have to say, well, you sell everything, et cetera, and get out of the way, except for the fact that March is actually, through May, is a strong seasonal time of year, and equities were doing pretty well up until now. So with that being said, what we did on Friday, again, is we put some smaller hedges in place, a door jam, if you will, to make sure, just in case going into the weekend, right, this is just smart risk management, to make sure that if we do have a large drop in prices, that we have some hedges in place that we may or may not take off quickly. And if the market goes up, you give up some upside with that. But again, last I checked, we're not in a bull market. we are in a market that's trying to get out of last year's bear market, right? We're still in the grizzly maze. So with that being said, again, we still have a large component in those Federal Reserve overnight treasuries earning over 4% and as such are in that range. We do have some hedged positions in there that get messy, right? They're not designed for alpha. They are designed, again, to slow the risk down. Again, as an analyst, sometimes, trying to disseminate this is that I'm looking at what they call VAR. You can Google that. It's value at risk. What is the worst case scenario of a loss and the probability within 1, 3, 5, again, 10% probability, not to get too granular, and then what is the risk management scenario? What is the worst case scenario? So day to day, if it looks like, well, I'm not making this much or the market was up this much and we sold that, ultimately, we try to slow that water tide down, okay? And again, in large market drops, that works because when you look in the rear view, you've lost a lot less, especially when the market's down 30, 40, 50%. Maybe not 15, 20, because that's still in the correction mode. All right, so with that being said, who knows if this is the canary? Again, from a balance sheet, income statement, and credit, you start to look at risk management, the use of different things when you remember the whole the Michael Burry story and all of that with credit default swaps and the CMOs, collateralized mortgage obligations, all of that. This does not look systemic, especially on larger banks who are so well capitalized. However, if the issue is in regional banks, what does that mean for venture capital, private equity? What does that mean for the system? Does the Fed keep increasing? Do they go 50 based upon some of this fluff in the employment markets? We don't know. And how's the market going to react? Well, I'll tell you this. Friday, some of the markets, again, started to creep below their 200-day moving average on 6 months charts. So if you're saying, well, why did you hedge then? Well, because we didn't see the bank thing happening Thursday. We had the jobs numbers Friday. And if things get ugly going into early this week, then again, you want to slow that process, right? Almost like in an accident situation where you want to don't slam on the brakes. You don't sell everything, right? You tap on the brakes, maneuver, and you may have to swerve. Okay, may get a little neck pain, but as long as you're not going through the windshield. With that being said, until next time, stay frosty. We appreciate your time, patience, and your trust. This is a process. It's not always clean. Sometimes it's making sausage. But again, no one works harder than us, and we appreciate your trust, and we'll talk to you soon. Jonathan Camarda.